problem with it is that if the economy turned down, the profits disappeared. When the profits disappeared, you couldn't make your payments on the debt. If you couldn't make your payments on the debt, you default. Okay? And so the competition with a small government capitalism but expensive capital assets couldn't work. You couldn't have economic downturns if you're indebted, because you're not going to be able to make the payments. You need a stabilizing force. The capitalist firms tried to create their own stabilizing force, which was to organize cartels. They thought the solution is to keep your prices up. Don't compete. Okay? If you can control your market and control your price, you can control your revenue, and then you can make your payments on your debt. So cartelization was a response to try to protect firms that are indebted because they have expensive plant and equipment. And in the United States, when President Roosevelt came in the beginning he wasn't a New Dealer. In the beginning, he tried to help the cartels keep the prices up. Okay? And some of you might know that this also was on the agenda for the fascists. Okay? And in those days, fascists didn't have the same meaning it has now. It was a form of capitalism in which the government helps to keep the prices up. It helps the cartels to cartelize the markets, to hold the prices up. Anyway, it doesn't work if demand is collapsing. You just can't sell. So we got the New Deal instead. We got a big government that operates to keep demand up. And that is a better solution to the problem of expensive capital equipment. So we come out of World War II with a new kind of capitalism. We called it paternalistic managerial welfare state capitalism. So these terms are all for the United States. In Europe, you could call it social democracy or something like that. Okay? In which the government plays a big role in keeping demand stable, guaranteeing markets for firms that are heavily indebted because they bought expensive capital equipment. So we have a new kind of capitalism. It's much more stable. It has a much bigger government. It has a government that has a deficit that can get really big in bad times to keep the profit flows going. So think of the Kolesky equation, how a budget deficit keeps profits up so firms can service their debt. This kind of capitalism was very stable. The problem is stability is destabilizing. So gradually over time, firms forget about the Great Depression, households forget about it, and they start going deeper into debt and taking riskier and riskier bets. So we have the rise of a new kind of capitalism, money manager capitalism. Okay? And not only have we had the government propping things up, firms becoming riskier, but we also had the buildup of financial assets. As debt is growing, so are financial assets, because assets are the other side of the coin to debts. So we have a huge accumulation of financial assets. A lot of these are in the hands of workers, not necessarily directly, but through their pension funds. We have universities in the United States who build up huge endowments. We have private individuals who have their own individual retirement accounts and retirement savings accounts. All of these funds have to be managed. This is why Minsky calls it money manager capitalism, because you have professionals who manage all this money. Because we had no Great Depressions after World War II, the managed money is never wiped out. We have financial crises, but none of those are big enough to wipe out very much wealth. This last one was big enough to wipe out a lot. I can't remember the number, but I think globally it's something like 20 trillion. A huge amount was wiped out in the last crisis. But before that one, it was never very much, not enough to make any difference. Other people have also seen that we have a new kind of capitalism. Minsky wasn't the only one or the first one to say this is a new kind of capitalism. I think his interpretation, for me, is the best one, but there are others that are also very good. Jamie Galbraith called it the predator state, and he captures an aspect that's not really in Minsky, and that is the cooperation between the government and favored firms. Okay, so depending on which administration is in power, that determines which are the favored firms the government is operating in their interest, so that they capture the government. Many people call it financialization, including the more left-wing people, and that also captures an important part of what's going on, financializing the whole economy. George Bush called it the ownership society, and that captures something. What he meant, I mean, it was always interpreted, oh, this is Junior, Bush Jr. Oh, isn't Bush great? He's trying to promote home ownership by lower income people. The reality always was he's promoting ownership by the top 1%. All of his policies were designed to benefit the top 1%. So it's an ownership society of the top 1%. They're going to own everything. Okay? And that captures a big aspect of what's going on because we had a tremendous increase in inequality. In Europe, we call it the neoliberalism. In the US, we call it neoconservatism. There's also the rise of shadow banking. So that's Paul McCulley's term. That captures an aspect of it too. A lot of this is outside the banking system. So that's also important. Okay, here's a very short synopsis of a Minsky view. So we had stability in the post-war period, but that breeds instability. We had a huge accumulation of financial assets and liabilities. We had globalization and securitization. Those two things came together because, for example, if you're a foreigner, there's no way for you to get a piece of the US real estate bubble unless we securitize. Because you're not going to make a home mortgage loan in the United States. Okay? Too idiosyncratic. What you want is to buy a package of home mortgages in a security. So securitization was essential to globalization of finance because you don't need to have a customer relationship like you do when you make a mortgage loan. Okay? So securitization, and we securitize everything. So everyone always uses home mortgages as the example, but everything is securitized. And that allows everybody in the world to buy it. So the Bank of China was buying US mortgage-backed securities. And of course they got screwed like everybody else. And they say, no more of that. We're not going to do that anymore. And finally, a lot of people say deregulation, but more accurate, you should call it self-supervision. What we did was we decided that the biggest financial institutions are so sophisticated and complex that the regulators cannot supervise them. We'll let them supervise themselves because they know what they're doing. The free market will work. Okay? And if you know anything about the Basel agreements are all about self-supervision for the biggest banks.
Yeah, we've studied that.
Okay.
Basel 1, Basel 2,
and 3. They're all about self-supervision with credit raters rating you. Okay, instead of having supervision by the regulators. Okay, Greenspan uses the term irrational exuberance, and that movie also, you know, if you think of this all was just a big bubble, people became irrational. That is wrong. That's not what was going on. So what burst the real estate bubble, okay, was these really bad mortgages that people couldn't afford to pay. And so, or you could say, you know, the actual event was, well, first it was two little banks, two little German banks that failed. And then you've got Bear and Lehman. You can say those were the trigger things. So you can always find a trigger, right, for the crisis. 1929 October, stock market crash. That's the trigger. But the seeds for the crisis have been sown a decade before that, right? And in this case, 2 decades, 3 decades before 2007. We're already on the path. So what is it? Here's a partial list. One is the Fed increasingly used aggressive interest rate changes. Volcker is the best example. What Volcker did was he raised the interest rate above 20%, the overnight interest rate. Now, if you're a Brazilian, that sounds, your reaction is, so? Their central bank does this all the time. In fact, 30%. Okay, in the US,
So in fact, Brazil was heavily indebted sometimes with the US. So if they really, Brazilians were interested in that.
yeah, well, for the US, our normal would be 6 or 7%. So we're talking about tripling the overnight interest rate. This had a huge impact. It devastated the savings and loans. And that's what triggered the savings and loan crisis. Because they were earning 6% on the mortgages. They're paying up to 20% to issue their own liabilities. So they're earning 6 and paying 18 or to 20.
That's when they wanted to prove practically the quantity theory of money.
That's what they
keep under control the,
yes,
okay, which they couldn't.
which they didn't.
Yeah.
So supposedly they were targeting money supply, and they let the interest rate go where the market took it, which was above 20%. In any case, what did the banks learn from that? They learned, the interest rate can go a lot higher than we ever thought possible. We don't want to hold mortgages anymore, because the next chairman might do the same thing. So that is when they started trying to get all mortgages off their balance sheets. And not just mortgages, but all kinds of loans. We don't want to hold them because the Fed might kill us again. So that was the initial impetus to start securitizing. And that eventually leads to, if we're going to securitize it, we don't need to do underwriting. We don't care if they can repay the loan because someone else is going to have it. Okay? So that all started because of Volcker. By financial institution innovations to make credit more elastic. So trying to find ways to greatly expand the supply of credit. And in a way that somebody else will take the risk. By deregulation and gradual removal of the New Deal constraints. So we got rid of, we've mentioned a few times, Glass-Steagall and other kinds of constraints that we had on financial institutions. By stagnant incomes, I already said they have not risen in real terms since 1974 in the United States. So consumers borrow instead. Their income isn't going up, so they're borrowing. Rising inequality. And the growth of managed money with an appetite for risk. This is very important. You have huge pools of funds that are managed. Every money manager has to beat the average to stay in business. Can all money managers beat the average? No. On average, they're going to be average. Okay? But the belief is there's a risk-return trade-off. So to beat the average, you have to be more risky. So there's a great incentive to increase riskiness. So that's extremely important to understand. Why are all these crazy innovations going on? Because every money manager has to beat the average. So they're inventing new products all the time that have a lot higher risk, that supposedly will give a higher than average